I made a couple videos about TTCF before. So that's my third one. And I want to use this to demonstrate something to you that you can have two companies or three companies, whatever, and their stocks might go down in a similar way. But it's completely two different stories, okay? One is caused by unreasonable market, macro, that's temporary, and one that is caused fundamentally, and it's never coming back, okay? So I think you know where I think I stand on something like TTCF, which has been the darling on YouTube at some point. So if you look at the chart, from its peak, it is down 92%, okay? Over the last year, I mean, complete devastation, 87%. And there's a lot of stocks that are down a lot. And you can say, well, but look at this. It's also down similar way. So I want to point you to the income statement for TTCF. So in 2019, the revenues were 85 million. Then next year was almost 150 million. And 2021, 213 million. So fantastic growth. But the problem with this business are the gross margins, okay? If you look at this 13 million here and compare it to 84, or 21 here and compare it to 148, or 22 and compare it to 213, the margins are tiny, 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 tiny. It's about 10% gross profit margin here. So, and then recently, the most recent quarter, like 3 months, ended September 20, the gross profit margin is negative, okay? Think about this for a second. You are selling pens, okay? Let's say you sell this for $1 and it costs you $1.50 to make it. You are losing on the cost of goods sold. And then after you make it, you still have to spend money on marketing, administrative, finance costs if you have debt. Like, how in the world are you going to ever make it money for investors if you can't even make money on making the freaking product? So then you ask yourself a question. Do I want to expand it to more stores? Like, if you're making, on $1, if you're making 50 cents, then yeah, it makes sense to expand it to a lot of stores. But if you're losing, then expanding to a lot of stores is a disaster, because now you're losing more money, right? And if we look at the balance sheet, in December 2020, okay, they had $131 million of cash. $131 million of cash. As reported, like a couple days ago, that is down to $14 million. $14 million, okay? From 130. And now, if you look at the current liabilities, now they have a line of credit. They took out $20 million of debt, right? Because if you're losing money, well, your cash is going to go down, okay? That's fine. And then once you run out of cash, then you either have to borrow, like they did, on the line of credit, or you have to issue more equity, right? And as I said, few days ago, they reported a quarter, and they said in there, the company also announced that it intends to raise additional debt or equity capital in the near future. So more debt or equity. Now, more equity means more dilution at the current price. More debt, well, that's deadly, especially when your business is not even not even making money on a gross margin level. Okay? So I don't know why anybody would lend them money on the debt. I have no idea. But if they do, I mean, this thing is going to zero. I mean, would you lend somebody money knowing that they cannot even make money on a gross margin basis? Like, after you make the money on the gross margin basis, then at some point you have to be profitable on the bottom line, right? So you have to have more gross margin to cover your marketing, to cover your general and administrative, and now to cover more debt that you're going to bring on, right? And so this decline here, that's not the market being stupid. That is permanent capital destruction, permanent value destruction. The business model doesn't work. And especially now with the inflationary pressures, they get pressured on the cost basis. And all over that Q reporting, they were talking about, oh, our costs went up to manufacture it because of inflationary pressures and, value chain disruptions. So the cost of goods sold is higher. And people are getting squeezed on everything they buy, right? So the last thing they're going to buy is overpriced vegan food, right? So their costs go up. They have to lower their cost to be more competitive. So the margins were already non-existent. Now they are like more non-existent, right? And now the growth is negative, right? The only reason why anybody is interested in unprofitable companies is so that because there's growth, right? And then with growth, at some point, the idea is that the company becomes profitable, right? That's the idea. That's why you sacrifice current profitability so that in the future, the revenues are big enough that they cover all the costs and the company is profitable. Tattooed Chef, I mean, it's a complete basket case. Like, I don't even know what hope people have. Like, a business like this shouldn't even exist. So if they take on any debt, and they already did, like 20 million, they take on any more debt, and then there's continuous pressure from inflation on their costs, and they cannot really raise prices that much to offset that. If the gross margin doesn't immediately get so huge, this thing is going to zero, especially when they put on more debt. It's going to zero. I don't see any hope for it. So that's the difference. That's the difference between a stock going down because of fundamental reasons and no hope for the company versus a stock going down because there's panic in the market, and the company, the thesis is the same, the technology is great, the solutions are great, and at some point the market is going to recognize it and the stock will rebound. Something like Tattooed Chef, there is no rebound. There is no hope. I don't see how they can possibly get those margins to levels where they can make this company profitable. And in order to do that, you have to lower your costs so much, and you're pretty much selling something that doesn't even have a moat, you don't even have a pricing power. But in order to lower your costs, you got to invest in a big manufacturing infrastructure. That requires a lot of money. Where is that money going to come from? Especially now, from debt or equity at these prices. If it's from equity, it's going to be hugely dilutive. If it's from debt, the expansion in margins better be like to 50 or 60%, which is very difficult in an industry like that. So anyway, tell me, maybe I'm wrong. I'm all ears. Tell me where there is hope in Tattooed Chef, because I don't see any hope, and I wouldn't be surprised if this thing goes to zero and becomes a penny stock. Anyway, any comments are appreciated.